Hi, this is Rusty Vanneman. I'm the Chief Investment Officer for CLS Investments, and welcome to the Market Review. This month I have with us Grant Engelbart, Portfolio Manager at CLS Investments. Welcome, Grant.
Thanks for having me, Rusty.
I have Grant because this month there was a lot of topics I wanted to write about, and so in the commentary there were 3 things I had talked about, and you wrote about each of them as well, or did research, so you're the perfect guest to have this month, so welcome. Well, first of all, let me just talk about the markets. We are doing this right before month end, and basically the takeaways are the U.S. market is flat right now, but it has nice momentum coming into month end. Smaller caps have clearly underperformed, but international stocks, again, are leading the way. Emerging markets are, again, leaders this month, which is great for our portfolios. It's our most prominent portfolio tilt. Bonds are up, another nice month for bonds, so it's been a good month for diversified portfolios. And about the only thing is that commodities are down again this month. But it's a good month for us, good month for investors. But there is one thing really interesting this year is that risk in the marketplace has been pretty exceptional. I think there's a couple different things going on. I mean, first of all, absolute volatility has plummeted. I don't think anyone would have guessed that at the beginning of the year. I've surely been writing about it, expect higher volatility, but absolute volatility has dropped to its lowest levels since the 1960s. But the other thing really fascinating is that correlations between investments have dropped and what that has meant to portfolios. And I'm going to give that ball to you. What do correlations mean? What does that mean for portfolios? What does it mean for CLS portfolios?
Sure.
Because you did a lot of work on it.
It's a great question. Obviously, CLS, we build multi-asset portfolios with all of those different asset classes you mentioned before and then some. And so correlations measure the degree of co-movement or movement between those asset classes. And what we've seen in a lot of asset classes, correlations have really dropped. And in some cases, there's no correlation between 2 different asset classes. So an extreme example, you mentioned commodities, agricultural commodities, which are really impacted by very different forces than a lot of things in the market. Their correlations have gone from slightly positive to global equities to the same degree but negative. And so that degree of change is really large over the last year. Other commodity sectors and some value-oriented sectors like financials, energy, obviously, and natural resources, the correlations have dropped significantly as well. And what that does is impact the beta, which is the overall risk contribution that those sectors have to a portfolio. And since we're overweight those areas, we're overweight value, that has dropped our portfolio risk. Now, on the other side of the coin, areas like technology and consumer discretionary stocks, which think FANG and FAMG, large drivers of the market and large active manager overweights, those correlations have risen, and the risk level of those stocks has gone up. So the difference between those means an overall drop for portfolio risk for CLS portfolios, but especially relative to our peers.
For truly global diversified portfolios, risk has dropped this year. Again, like for us, some people have asked, are we getting more defensive because they see those risk numbers drop? That's not the case. It's just these correlations are plummeting, which is really, really notable. Another way to talk about correlations is that, I found an easy way to talk about it. Let's say you have investment A. Let's say it has a standard deviation of 20%, and you have an investment B, which also has a standard deviation of 20%. If they have a perfect correlation of 1, that means every time A goes up, B goes up. Every time A goes down, B goes down. If you mix the 2 together 50-50, you're going to get a risk of 20%. But the correlations aren't like 1, and since they've dropped, if you mix these 2 volatile investments, and let's say they have a really low correlation, your overall portfolio volatility could be significantly lower than 20%. And that's what we're seeing. So it's been a very smooth ride out there, and it's been an exceptionally smooth ride for CLS portfolios, and so that's great. All right, so one change that I talk about in the commentary is, and it's a topic that you do a ton of work at CLS, is we have kind of rebranded one of our return drivers from technicals, which is a study of technical analysis, which is a study of prices, to behavioral, because it's more encompassing, it's more representative of how we think. You do a lot of work on technicals. You do a ton of work on sentiment analysis. Talk a little bit about that work.
Sure. So, I think it's a great idea to rebrand that kind of category to behavioral and look at sentiment and technicals. Yeah. Every week we do what we call a relative performance chart pack for every single ETF. That comes out on a weekly basis, and what we're doing is measuring trend, mean reversion, moving averages, short-term, long-term momentum. We're looking at that for every ETF out there and our major asset classes.
Yeah.
So we use that to inform trade timing decisions in the short term. We have the longer term valuation measures and fundamental aspects that we look at in different ETFs that we purchase and different asset classes that we go into. But we use this to help inform those trading decisions. Sentiment also, in the piece, there's a great quote from Warren Buffett, whose birthday was last Wednesday. Shout out. That he talks about the in the short term, the market is a voting machine, right?
Yeah.
And so the behavior of investors in the short term is very impactful on the market. And sentiment we've seen is still continues, even though it's been tracked for a number of years, even decades, has a very large impact on how markets behave in the short term. So we try to incorporate both of those into our trade timing decisions.
Yeah, well said. And that's the reason why you're here. That's well said. By the way, I do go into some of this detail too, not only in the commentary, but also on our podcast. I just want to put a quick plug in it we changed our podcast format this month. And usually we've always used it as a teaser, and we actually expanded it to about a half hour. So we kind of go into some of that. All right, and last topic that I talked about, and I spent all this work on it, and then I realized you were writing an article on it as well. And of course, yours was like more fun to read than mine. But talking about benchmarks, and it doesn't sound like a very exciting topic, but it's really important for so many different reasons. And let's just go to kind of the main point that you were making, which is one of the points in my commentary too. But everybody wants to talk about like the Dow Jones, and there's like a 100-point move, like, oh my gosh, a 100-point move in the Dow. Why is the Dow not a great benchmark to follow?
Yeah, it's a great question. I mean, it's so prominent, and I get an alert on my phone probably 3 times a day telling me how many points the Dow has moved. Mm-hmm. But it's price-weighted index, and there's only 30 names. So kind of looking at those in context, yes, there are 30 large names that have larger market caps, but it's only about 20% of the overall market.
Yeah, exactly.
And the price-weighted indices are determined and weighted by, of course, price. So the highest share price, which is really kind of an arbitrary figure, as companies can split their shares and reverse split their shares. The highest share price in the index has the largest weight. So Boeing, for instance, is by far the largest holding in the Dow Jones.
Isn't Boeing the most important company in the economy?
Boeing's a great and amazing company, but it's the 32nd largest as far as market cap in the United States, and it's down there in the 20s, I believe, as far as revenue in the United States as well. So that doesn't really jive with what the index is trying to capture. Back in the days of railroads and banks, I think maybe that was more appropriate when the Dow was launched. But nowadays, I don't think it captures. Obviously, it doesn't capture the entire market like it should.
So what should we look at instead of the Dow Jones?
Great question. The Russell 3000 is kind of our preferred metric, right? 3,000 stocks. There are a few more than that in the United States, but most of those are very small microcap companies that most people have no business investing in. So that's going to be very encompassing of the overall market cap.
But so we have that on all our performance reports. It captures large, mid, and small, but it's not on television. So of the big 3 on television, which should we follow?
That's
obviously
a great
not
point.
The Dow.
Yeah, the S&P has its own flaws, but it is, again, 500 stocks that is going to be more encompassing than the Dow or the NASDAQ. Yeah. And so at a minimum, we'd like investors to pay attention to that. But, really, someday we'll get to the all-country world index where investors are looking at the global stock market on a daily basis rather than just the Dow.
And that's why we list that in the performance reports. We do have the S&P in our performance reports because it's just so popular. Right. It is, as you said, an imperfect benchmark. It's only about 80% of the overall market cap, and we consider it sort of a proxy for large companies, though it has some mid-sized companies too. Last comment on the NASDAQ, since we're like kicking stuff around, is that the NASDAQ, meanwhile, another one of the big 3, but I think it's kind of a carryover from the late 90s when a lot of investors got involved. Again, it's an imperfect proxy for technology stocks. It has a lot more stuff going on in technology. Again, it's only about a third of the market. So again, it's another index. Just ignore it, I think.
And you've seen companies can move their listings from the NYSE to the NASDAQ, and so you have an impact from that over time as well. And it's giving kind of weird reads on what the overall U.S. economy looks like.
So in my commentary, we talk about all this. I talk about, and it goes into more about fundamentally weighted indexes because that really ties into smart beta ETFs, which we're a big user of. And so anyway, there's just all kinds of goodies packed into it. It doesn't sound like a great topic, but I think it is. So
it's a great read.
Anyway, well, thanks for your time, Grant. We'll have you back sometime.
Absolutely.
All right, great. Well, thank you for your time and trust in CLS Investments, and we will see you next month. Thank you.